Stop believing fairy tales. Stop believing that the price of silver is determined by simple supply and demand. And stop believing that the United States financial system operates as a free market. Because today, we have the smoking gun. We now have evidence that strongly suggests the game is rigged. The casino is fixed. The dice are loaded. And for the first time, the people running this system may have pushed too far. It is Wednesday, February 4th, 2026. The headline you should be seeing everywhere is simple. The price is fake. According to intelligence circulating among market professionals, a single investor with over $100 million in capital, a true whale, has been quietly building positions in the silver market. This is not a retail trader. This is not social media speculation. This is a sophisticated institutional player with the resources to audit market structure at the highest level. And what this investor claims to have uncovered is explosive. They have reportedly assembled detailed, tick-by-tick forensic data suggesting that algorithmic pricing systems used by major bullion banks do not reflect genuine market activity. Remember the so-called glitch last week. Remember when the CME went dark. Remember the sudden price collapse with no fundamental trigger. We were told it was a technical issue, a reporting error, a harmless malfunction. This investor argues it was neither. They claim it was evidence of systematic manipulation. Here's how the mechanism allegedly works. When you place an order to buy silver, the bank's high-frequency trading systems see that order milliseconds before it reaches the open market. They step in front of you. They buy first. Then, they sell the same position back to you at a slightly higher price. It looks insignificant. Pennies per trade. But multiplied millions of times a day, those pennies become billions of dollars quietly transferred from pensions, savings, and retirement accounts into institutional profit pools. That's front-running. And spoofing is even more aggressive. This is when massive sell orders, sometimes thousands of contracts, are placed on the order book with no intention of being filled. The market sees a wall of selling. Traders panic. Algorithms react. Price drops. Then, just before execution, those sell orders vanish. The price collapses, liquidity dries up, and the same players step in to buy at artificially suppressed levels. According to this analysis, the silver market is not being priced. It's being managed. And if these findings are validated, they don't just expose bad behavior. They expose a structural failure at the core of modern price discovery. This isn't volatility. This isn't speculation. This is control. And once confidence breaks, it doesn't come back quietly. The price crashes. But here's the trick. They never intended to sell. The moment the price drops, the order is canceled. Nothing was real. You were never trading against a seller. You were reacting to a ghost. They flashed a fake wall of supply, scared real investors into selling real metal, and then erased the order as soon as the damage was done. That's spoofing. It's the financial equivalent of yelling, "Fire," in a crowded theater so you can grab whatever people drop on the way out. And for years, anyone who pointed this out was dismissed. Called paranoid. Labeled a conspiracy theorist. Now the tone has changed. Regulators are quietly acknowledging what the public was never supposed to see. We are hearing reports of a settlement. A fine approaching $1 billion. And here's the insult. If you steal $10 billion, distort the price of a strategic global asset, and undermine market trust worldwide, a $1 billion fine is not a punishment. It's a fee. It's the cost of doing business. It's the system saying, keep the profits, just share a percentage with the state. So why now? Why is this evidence surfacing today? Because the manipulation has finally broken something that cannot be patched with software. You can suppress the price of a paper contract indefinitely. You cannot suppress physical reality. prices have been held so low for so long that mining operations are shutting down. Refiners are running below capacity. Inventories are vanishing. The strategy worked too well. It created a shortage so severe that even the institutions benefiting from the manipulation are now exposed. They're trying to hold a beach ball underwater. But the pressure keeps building. And the beach ball is starting to look more like a naval mine. While algorithms play games in New York and London, the real world is running out of metal. And now we are hearing something extraordinary. Confirmation from the heart of the global banking system. Switzerland. Reports are emerging that key vaults are effectively empty. That delivery timelines are stretching. That the illusion of abundance is breaking down. The free market narrative is cracking. What's underneath is not volatility. It's scarcity. And the most dangerous evidence is not a spreadsheet or a trading chart. It's thousands of miles away, deep in the Alps. Because if you want to understand how artificial the price really is, you have to look at the one place on Earth that has always had metal. Switzerland. The refining capital of the world. The vault of the global elite. The place that never runs out. Until now. This is where the metal is refined, stamped, and stored for generations. If physical silver exists anywhere, it exists in Zurich or Ticino. And today, we received a report that should stop you cold. We have a trusted source, a senior executive at one of Switzerland's largest physical bullion dealers, speaking on the record. His message was simple. And it was devastating. We have zero stock of silver. Let that register. Not low inventory. Not shipping delays. Zero. He went on to explain that they have been unable to secure a single meaningful delivery of physical silver for weeks. Refineries are operating on residual feedstock. Wholesalers are empty. And the authorized participants, the banks meant to supply liquidity to the system, have gone silent. They are calling London. They are calling New York. And the response is the same. There is nothing available. Now look at the screen in front of you. The ticker says silver is trading at $86 an ounce. The computer insists supply is available. But the largest bullion dealers in the wealthiest country in Europe say they cannot buy silver at any price. That is the disconnect. That is the break. The paper market is signaling abundance. The physical market is signaling extinction. And this tells us something critical about the price collapse earlier this week. It failed. The banks drove the price down to flush out physical holders. They expected fear. They expected forced selling. It never came. The Swiss didn't sell. Long-term investors didn't sell. Instead, the lower price accelerated the drain. It turned into a clearance sign on an empty shelf. Demand surged. Supply was already gone. Now consider what this means for Europe. If Switzerland is dry, the strategic buffer for the entire continent is gone with it. German and French manufacturers rely on Swiss refineries for silver paste, wire, and industrial inputs. Volkswagen, Siemens, Airbus. These companies are discovering that you cannot build vehicles, turbines, or aircraft with futures contracts. You need atoms. And the atoms are missing. This is the cost of years of paper suppression. This is what happens when financial engineering replaces physical reality. So the question becomes simple. If the metal isn't in Switzerland, where did it go? It went to the new longs. And they are not selling. They went to the people we're talking about next. They went to the entities that are now attacking the comics. Because while Swiss vaults are sitting empty, American vaults are being drained. The zero stock report out of Switzerland is the canary in the coal mine. It's the warning signal that the system has seized up. The engine has run out of oil, but the dashboard still says everything is fine. And that engine is close to blowing. To understand the second half of this failure, we have to shift our focus to New York. We have to look at how smart money reacted when Switzerland ran dry. They didn't sell. They demanded delivery. 14 million ounces. 4 days. And if you want to see panic in real time, you don't need to fly to Zurich. You just need to look at the COMEX ledger. Because while the Swiss vaults are empty, the American vaults are being raided with a speed and intensity we've never seen before. This is a bank run happening at institutional scale. And it's moving so fast that regulators don't have time to paper it over. Let's look at the data. Specifically, what happened in the first 96 hours of February. First, you need to understand the rules of this market. February is a non-delivery month for silver futures. It's supposed to be quiet, low volume, almost no delivery notices. The major delivery months are March, May, July, September, and December. February is the off-season. In theory, traders should be on vacation. But this February, the vacation was canceled. In just the first 4 days of the month, 2,955 delivery notices were issued. That number matters, because in a non-delivery month, it's not just unusual, it's extreme. Now let's do the math. Each futures contract represents 5,000 ounces of silver. Multiply that by 2,955 contracts. That equals 14,775,000 ounces. Nearly 15 million ounces of physical silver demanded for immediate delivery in 4 days, during a month when almost no one is supposed to take delivery at all. This is not normal market behavior. This is a raid. It's the equivalent of a crowd showing up at a quiet neighborhood bank on a Sunday morning and demanding tens of billions of dollars in cash. The system isn't built for this. Warehouses aren't staffed for it. Armored transport isn't scheduled for it. Logistics break under this kind of pressure. But here's the detail that confirms this isn't random. If you look at open interest, the number of active contracts, it doesn't collapse the way it normally would after delivery. Which means these positions weren't closed. They were rolled, replaced, and reinforced. This isn't panic selling. This is coordinated accumulation. And that's where the story gets dangerous. Because when physical demand accelerates while inventories are already depleted, price discovery doesn't adjust smoothly. It snaps. And the next move doesn't come from an algorithm. It comes from scarcity. At the close of business on January 31st, open interest for February silver contracts was tiny. Just 1,231 contracts. That matters because in a normal market, delivery can only come from existing contracts. If every single holder on January 31st demanded delivery, the absolute maximum number of notices should have been 1,231. That's the ceiling. But that's not what happened. The actual number of delivery notices was 2,955. So where did the extra 1,700 contracts come from? Where did the demand for another 8 million ounces suddenly appear? It came from new money. Entities entered the market on February 1st, 2nd, and 3rd. And they didn't enter to trade. They didn't enter to hedge. They entered to extract metal. They bought contracts at 9 a.m. and demanded delivery at 9:01. They used the futures market like a grocery store. They walked in, cleared the shelves, and walked out the back door with physical silver before the ink was dry on the receipt. That behavior tells you everything you need to know. This is not opportunistic buying. This is not speculation. This is fear. This is the behavior of buyers who know Switzerland is empty. Buyers who understand that if they don't secure metal now, there may not be another chance. They don't care that February is a non-delivery month. They don't care about premiums. They don't care about optics. They care about ounces. And right now, they are draining the COMEX at roughly 3.5 million ounces per day. At that pace, registered inventory doesn't last the month. This 14 million ounce drawdown is the smoking gun. It proves the price smash failed. It didn't scare demand away. It signaled weakness. It told the sharks the bank is bleeding. And now the sharks are circling. Which brings us to the most important question of all. Who is doing this? Who has the capital, the logistics, and the nerve to walk into the COMEX, put $1 billion on the table, and say, deliver the metal now? We call them the new longs. And they are the most dangerous threat the manipulation cartel has ever faced. To understand why, you have to look at the mechanics. In a normal market, you buy a contract and you wait. You roll it. You settle it in cash. You play the game. The new longs didn't play the game. The data shows that roughly 1,700 contracts were bought and exercised almost immediately. No holding period. No rolling. No patience. They entered the market with one objective only: to convert paper into metal as fast as possible. And that is something this system was never designed to survive. 50 years. That's how long this move changes the game. They are putting a floor under the price. Now we need to talk about the bombshell that just came out of Washington. Because this is where the free market officially ends and the government market begins. The raid on the COMEX is only a symptom. The cause, and possibly the final nail in the coffin of free market pricing, was announced just hours ago in Washington, D.C. If you think the new longs attacking the exchange is big news, what comes next rewrites the physics of the silver market. For years, we warned that paper pricing was destroying the physical supply chain, that artificially low prices were starving miners, shutting down expansion, and hollowing out inventories. Today, the U.S. government admitted it. At the Critical Minerals Summit, the keynote address wasn't a formality. It was delivered by Vice President J.D. Vance. And what he announced sent shockwaves through global trading desks. He formally announced the creation of a critical minerals trading bloc. This is a coalition of more than 50 nations, including Canada, Australia, Mexico, and members of the European Union, coordinating strategic resource policy. That alone is historic. But that's not the real headline. The headline is how they plan to secure supply. Vice President Vance used two words that Wall Street hates, but miners have been waiting decades to hear: price floors. Let that sink in. The United States government has explicitly stated it will establish strategic price floors for critical commodities, including silver, cobalt, and rare earth elements. This is not guidance. This is not a suggestion. This is intervention. They are saying the paper market will no longer be allowed to drive prices below the cost of production. They are saying if banks smash silver to $80, the trading bloc will step in and buy everything at $100. That is not a free market. That is managed pricing. And it exists for one reason: survival. When policymakers looked at the data, they saw the crash to $86 and understood the consequence. At that price, primary silver mines in the Americas cannot expand. They cannot explore. They cannot build the infrastructure needed for electrification, defense systems, or industrial manufacturing. Low prices weren't helping consumers. They were starving Western supply. And worse, they were feeding China. Every time banks crushed the price, China bought the dip. Every smash was a subsidy for Beijing. Every low tick was a transfer of strategic material from Western mines to Eastern stockpiles. That realization changed everything. National security outweighed banking profits. The illusion of the free market collapsed under the weight of reality. And with that decision, the rules of the silver market changed permanently. This isn't speculation anymore. This is policy. And policy doesn't blink. They're taking the toys away from the toddlers on Wall Street. They are effectively putting a put option under the entire silver market. Now think about what that actually means for you as an investor. Historically, when you buy silver, the fear is always the downside. What if it crashes? What if it goes to $50? That fear just disappeared. Because the Vice President of the United States just told you something extraordinary. He told you that the most powerful economic bloc in history will not allow the price to collapse. They will be the buyer of last resort. That changes everything. This is the end of the manipulation era as we knew it. Banks can spoof. They can front-run. They can play games inside the paper market. But they cannot fight a government with an infinite balance sheet and a mandate to hoard physical metal. If a bank tries to short silver down to $80 and the U.S. government has a standing order to buy at $90, the bank doesn't win. It gets crushed. The government floor becomes reality. And once a floor exists, the math only works one way. Up. This is a return to Cold War logic. Strategic stockpiles. Guaranteed supply. Managed pricing. But this time, it isn't just about bullets and tanks. It's about survival. Silver is required for solar panels that power the grid, for microchips that run AI, for defense systems, communications, and electrification. The U.S. government has officially acknowledged that silver is not a speculative asset. It is a strategic metal. And strategic metals do not trade in free markets. They trade in security markets. That admission kills the bear case. You cannot bet against a price when the government is actively engineering it higher. The smash is over. The floor is in. And now look at the full picture. Switzerland is empty. The new longs are draining COMEX inventories at record speed. And the U.S. government has stepped in as the ultimate whale. That combination leaves one conclusion. The price has no ceiling. So here is the final verdict. We peeled back every layer. We started with the smoking gun. A 9-figure investor proving algorithmic manipulation. We moved to Switzerland and saw zero stock at the heart of global refining. We watched nearly 15 million ounces vanish from COMEX in 4 days. And finally, we heard it from Washington itself. Price floors. For the last 50 years, silver was treated like a casino chip, a paper asset, a tool for leverage and suppression. That era is over. What replaces it is not speculation. It's strategy. And in a strategic market, the metal doesn't chase the price. The price chases the metal. That's where we are now. And once you understand that, everything else becomes very simple. For the last 50 years, the rig was designed to push prices down. It was designed to make the dollar look strong and metals look weak. It was a financial weapon. As of today, that rig is flipped. The United States government has realized that suppressing silver is no longer harmless. It is a national security threat. It is starving domestic mines. It is emptying Western vaults. And it is handing the future to China. So the policy changed. They are now rigging the price up. By stepping in as the buyer of last resort, the government is guaranteeing that mines stay open and physical metal stays in the West. This makes a bear market mathematically impossible. You cannot have a crash when the entity with the printing press has placed a floor under the market. If the price drops, the government buys. The downside no longer exists. The put option is live. And this leads to the most important realization for you, the individual stacker. You cannot buy cheaper than the government. Once a trading block establishes a price floor, whether it's $100 or higher, you will never see today's paper prices again. $86 silver becomes history. The window you are looking at right now is not a rally setup. It is a mispricing. It exists because the old algorithm is still suppressing price while the new government floor is being built underneath it. That gap is the arbitrage of a lifetime. Today, you can still buy silver at the banker's fake price. Tomorrow, you may be forced to buy it at the government's real price. And the difference between those two numbers will not be small. Do not wait for the official announcement. Do not wait for the Critical Minerals Act to be signed into law. By then, premiums will explode. By then, dealers will be empty. The new longs understand this. That's why they drained 14 million ounces in 1 week. The Swiss understand this. That's why they are hoarding. And now, you understand it. The smash is over. The free market is over. Welcome to the era of strategic scarcity. The United States government just joined the squeeze. You are now on the same side of the trade as the printing press. Do not bet against the whale. Become the whale. This is Asian Guy.